Hello everybody, Brian Mirau here with Mirau Capital Management. Today we're going to talk about our 8 different pockets of money. And there's literally about 8 places you can go to invest your money. And I know there's some hybrids of these and there may be a couple of more, but these are traditionally the 8 buckets that we see that people have their assets invested into. Now we literally have 8 places we can go to invest our money. Okay, so when we start looking at these 8 places, well, there's a lot of different questions we have to answer to determine which one's best for us. But let's talk about each and every one of these. When we start looking at where we can go to invest our money, the first thing we have to ask ourselves is what is our goal? What's our objective? What are we trying to accomplish with this pocket of money that you have? And a lot of our clients say, Brian, well, we like to be efficient against taxes. They say we like to be efficient against inflation. They say we like to be efficient against unnecessary fees and expenses. They say we like to be efficient against this risk stuff because we don't like this up and down stuff of the market anymore. Not like we did when we were younger. And we like to have a chance to earn a reasonable rate of return on our money. And we always bring that question up. What do you think is a reasonable rate of return? And where can we go to get that? Well, if you look at what the market has done over the history of time, it's given us typically a better rate of return than traditional fixed investments because we're in a 50-year low interest rate environment right now. But when we start looking, most people say, Brian, if we could earn 5, 6, 7% on our money, we think that would be reasonable. That's what most people tell me. So if we think that a 5 to 7% rate of return is reasonable, then the question we've got to ask ourselves is, where can we go to get that? What are our choices out here? Well, like I said, there's 8 places we can typically go to invest our money. Okay, we can invest our money into stocks. We can invest our money into bonds. We can buy mutual funds. We can buy variable annuities. Okay, then we can go over here and we can invest our money into fixed indexed annuities. We can buy fixed annuities. We can buy CDs. Okay, or we can leave our money in cash. Cash being like savings account, money market accounts, and things like that. But these are typically the 8 places we can go to invest our money. Now let's talk about each and every one of these. We know we can go into stocks and have a chance to get a 5 to 7% rate of return because we know stocks can go way up, right? Absolutely. Okay, we can see those stocks go up. But we also know what? We also know this market can correct and we can see those stocks go down. Bonds can go up like stocks, typically not as much, but we're kind of in a dangerous bond environment today. The reason why we're in a dangerous bond environment today is because we are in a 50-year low interest rate environment. And there's an inverse relationship between bonds and interest rates. When interest rates are down, bonds are up. When interest rates go up, bonds come down. So then we find ourselves holding an appreciating asset in a rising interest rate environment. Now, typically, if you hold those bonds and they're good rated bonds and you hold them till maturity, you should get your money back out. But a lot of times we'll see a lot of these maturity dates 20, 30 years down the road. And if you're a retiree, a lot of my retiree clients say, Brian, I don't like to have to wait 20 or 30 years just to guarantee the safety of my investment here. And I might need to be pulling that money out. So that's kind of the challenge that we have in the bond environment today, is because we're in this 50-year low interest rate environment. And, where you always ask people, where do you think interest rates are going? And most people out here said, well, they can't stay this low very long, but we think interest rates are going to go up. So that can create a problem in the bond environment today. And then we have these things called mutual funds. A mutual fund is where we're going to pay a fund manager a fee. And this fund manager is going to buy stocks or bonds or a combination of stocks and bonds. Those can go up with the market, okay? And we also know that they can go down with the market as well. Here we have to start watching out for the unnecessary fees and expenses inside mutual funds. Now, like I said on one of my earlier segments, is, I don't have a problem for a good day's pay for a good day's work. However, we don't want to pay any unnecessary fees and expenses. So you got to watch out for that, okay, when it comes to mutual funds. And then we have these things called variable annuities. They kind of look and smell like a mutual fund, except they're under the umbrella of an annuity account issued by an insurance company. And they can go up with the market like mutual funds can, but we can also see downturns in variable annuities like we do mutual funds. And you have the same kind of management fees here that you have over here, but you have another set of fees called M and E charges. That stands for mortality and expense charges. And a lot of these variable annuities, they'll have what they call a death benefit guarantee. So if something happens to you and you die, they'll give the principal amount, or there may be a guarantee in there for the beneficiary in the event of death. And that's what these mortality and expense charges are. And it's like buying insurance inside the account. And then we've got these things called fixed indexed annuities. What these do is they give you market growth like we get over here, but they put a cap on your top side. So you don't get all the market growth that you get over here, okay, but it participates in like one of the indexes like the Dow or the S&P 500, or there's different hybrid type indexes out there. And what they do is they give you upside growth potential, okay, but they don't have any downside risk. So they can go up, but they have no downside risk. And again, we don't get the catch to that is they don't give us typically 100% of what we could earn over here in the market. They put a cap on these things. And then we have fixed annuities. Fixed annuity is nothing more than a time deposit with an insurance company, kind of like a CD is a time deposit at the bank. What we're seeing out here, in fact, all three of these are time deposits. And then we have this stuff called cash, which that's kind of like our money market accounts and savings accounts. We're not seeing much in the way of growth there, but these are typically the 8 places we can go to invest our money. But the first thing people ask me is, Brian, well, what should we use? Well, we have 2 sides of the spectrum. Okay, everything that we have on this side of the spectrum is what we call our safe money. Okay, and along with our safe money, we have guarantees. Okay, everything that we have over on this side of the spectrum is what we call our risk money. Okay, and along with the money over here, okay, these assets can go up and they can go down, but we have an opportunity for loss over here, okay, on the risk side. So we want to make sure that our portfolio is balanced between these 2 sides, and we want to make sure that we try to solve safe money issues using safe money solutions, and we want to use risk solutions for risk solutions for where we're trying to maximize and participate in the market. So these are the 8 places that we can go to invest our money.